Welcome to today's market report.
European shares hit more than one-year lows on Thursday as slowing Eurozone business activity highlighted growth worries, while German shares dropped 1.8% after the country triggered the alarm stage of its emergency gas plan. The continent-wide Stoxx 600 index dropped 0.8%, with Eurozone banks shedding 4.5%. Eurozone bond yields also slid, as did the euro. At S&P Global, a survey showed Eurozone business growth slowed significantly this month and by much more than expected, as consumers concerned about soaring bills opted to stay at home and defer purchases to save money. A PMI covering the bloc's dominant services industry sank to 52.8 from 56.1. There was this underlying expectation that services are still doing well. The PMIs poured some cold water on that belief. Other economically sensitive sectors, including automakers, miners, and oil and gas stocks, slipped between 2% and 3.6%. Healthcare, utilities, and some luxury names were the only gainers on Thursday. Until central banks get some signal to pivot towards a more dovish stance, the market will continue to focus on downside risks to growth. The ECB is set to raise its deposit rate above zero next month, while US Fed Reserve Chair Jerome Powell reiterated the US central bank's commitment to control inflation even at the risk of an economic downturn. Norway's central bank raised its benchmark interest rates by 50 basis points on Thursday, its largest hike since 2002. Traders are scaling back their bet on how far central banks will be able to lift interest rates this cycle as recession fears grip. European shares had briefly cut session losses to edge up, tracking a rally in US stock futures before moving back into the red, even after a strong open on Wall Street. GBP/USD is down on the day by some 0.33%, trading at 122.20. after UK PMIs came in roughly in line with expectations in June and in choppy market conditions. Eurodollar has turned sideways to 105.20.
This is today's market news. Thanks for listening. We'll see you next time.